It's 11 a.m. on the East Coast. Guy Adami here. Dan Nathan. You see Dan right in the center square like Paul Lind, actually, if memory serves well. And we've been talking about this for a while. We love FactSet. They've been such a great partner with us. And we've been talking about the 3 E's for 2023. Energy, ESG, and earnings. And who better to do it with than those 3 distinguished gentlemen you see before you. Obviously, we're going to get into it. Dan Nathan, how are you?
I'm doing well. This is great for us here because we have, I think many of our market call viewers, they have gotten to know John Butters. He's the vice president and senior earnings analyst over there at FactSet. I know that we've also had Matthew Hagerty on the program, senior manager of energy analysis, and Eli Reisman. He's the SVP and senior director of ESG product management. Thank you guys all for joining us. We think that these 3 topics, as we think about 2023, are all going to be really important. We've been tracking a lot of stuff on the earnings front. We find the Earnings Insight blog that we get a preview of on Thursdays, and we get to talk about it on Market Call that drops Friday on FactSet's blog there. And maybe we can show you guys where you can subscribe to all of their work right there. There it is, insight.factset.com/subscribe. So you can get all these gentlemen's work in your inbox. So subscribe right there. Guys, thanks for being here. We want to start with earnings because this is one where, Guy and I, we track it every week. It's something we talk about on CNBC's Fast Money. Earnings inputs are really very important as we think about expectations, as we think about valuation levels, and we think about where things are going and how we kind of arrive at our macro thesis with stocks. John Butters, our viewers, they know you, they love you. We just call you, what do we call him, Guy?
Butters. I mean, it's like Cher, Bono. Bono was there last night, by the way, and during the State of the Union. I'm saying to myself, next year, I'm going to go from Bono to Butters, but that's neither here nor there, Dan.
I don't think John Butters wants to be in the State of the Union anytime soon, as we've gotten to know him. But John, let's talk about what expectations are for 2023. Because again, when we think about earnings estimates for the S&P 500, we're always thinking it relative to price. We're always thinking it relative to where investors feel comfortable buying stocks, where they start to get nervous about buying stocks. And that's all relative to growth expectations here. Give us a sense for coming into the year before we had this kind of 7.5% rip in the S&P 500. Where were expectations for the full year?
Yeah, so if we look at the first half of 2022, analysts were actually steadily raising their estimates for 2023. And we peaked at about $250 per share, through May into June. And then really the end of June marked a transition point, and analysts really started taking their estimates down. And as you can see in this chart, it's really been a steady decline through the end of 2022 and into the first 5 or 6 weeks here of 2023. Obviously, it's been this earnings season for Q4 has been below average. We've seen, by any of the metrics. And as a result, analysts have continued to take their numbers down. So at the start of the year, we're looking at $230 per share. That's come down to $224 per share. If we look at the sectors, multiple sectors have seen numbers come down. And what is interesting, as you noted, while these numbers have come down over the last 6 weeks, the market has gone up. Mm-hmm. So the P/E ratio, we've actually seen an expansion of multiples over these last few weeks. So back on December 31st, forward PE for the S&P 500 was 16.7. Today, that's up to 18.1. That's above the 10-year average of 17. So, you usually don't see this happen, but earnings coming down, the price go up, and we now see a much higher multiple than we did just a few weeks ago. Yeah,
it's interesting, Dan. I said similar last night on Fast Money. I said, let's just make this into a math problem. I said, if you give the market an 18 multiple, basically at 41.50, it's effectively where we closed. You're looking at a market that's trading around $231 or so worth of earnings. And I said, that number is probably, John, 12 to 15% too large, too overinflated, and an 18 multiple in this environment is probably 2 turns too expensive. So maybe can you walk through that? Because you just hit that nail right on the head.
Yeah, and what's also interesting, and I think we've talked about this before, so analysts do typically overestimate annual earnings 1 year in advance. Over the past 25 years, the average overestimation has been about 7%. So again, I'm not making a prediction, but take that 230, apply the 7%, that gets you down in the 214, 215 range. But what's even more interesting, if we look at the growth rate numbers, actually, I was just going to reference this chart. All of this growth is really expected to happen in the second half of the year. If we look at the first half, we're looking at expected earnings declines in Q1 and Q2 with an expected recovery in the second half of the year. And not only are analysts more optimistic, looking, 1 year in advance. They're more or less optimistic the further out you go. If we looked at a similar chart last year for 2022, you'd see a similar pattern where there was a much greater earnings growth expected in the second half of 2022, and that didn't happen. The first half saw most of the growth. The second half saw weaker growth. So, we're 60% of the way through this earnings season, so we'll certainly watch to see if these numbers where these numbers move over the second part of this earnings season. But right now, there is an expectation of a second half recovery in earnings in 2023.
Yeah, not just that. I mean, from your work here, it looks like 11% expected earnings growth in 2024. Speak to a little bit about, let's just say, if 2023 comes in less than expected, that's where you expect the ricochet in the out years. So talk to us a little bit about how you think investors think about that right now, because I think Guy and I, this is not your job to make those sorts of predictions. You're just looking at the data here and interpreting it a bit. I mean, Guy and I think that 2023 is still too high, and we think it probably settles out somewhere maybe flattish or so. I think there's a lot of prominent strategists out there who think that we could be down single-digit percentage by the end of the year here. But then that just gives more oomph on the way out, I guess, in 2024.
Right. So, when we look at 2023, again, at the sector level, it is interesting that there's, a lot of optimism from the analysts in terms of, 8 of the 11 sectors are expected to see earnings growth. And, if we go to that chart with the sector breakdown, it's interesting that they're expecting a big recovery in the consumer discretionary sector. And I think we talked about this a little bit the last time I was on, but a lot of that rebound in consumer discretionary is expected to happen with Amazon, which actually reported a loss in 2022 and is expected to see a profit rebound in 2023. And then also the hotels, restaurants, and leisure space are expected to see a big rebound. And, it's interesting thinking about that industry. If we have any sort of an economic slowdown, that's likely an industry that's not going to perform. However, on the other hand, if we look at the most recent jobs report, that was an industry that saw the largest job growth, right? The hospitality and leisure space. So, some interesting crosswinds as we look at some of these trends in 2023. And on the flip side, energy expected to be down about 16%. And again, energy was the largest contributor to growth in 2022. That sector had, 150% growth, so facing a difficult comparison. So again, I think it's interesting that, you noted looking ahead to 2024, some of the areas in 2023 that are expected to rebound or expected to see an opposite performance than what we saw in 2022. So it'll be interesting to see how that plays out in 2023 and if we see a similar trend in 2024.
John, you analyze the data, and I would submit, I think Dan as well. You do it probably as well, if not better, than anybody else out there. But you're also sort of a student of history, and you've been doing this for quite some time. I've said this on the show. I've said this on Market Call, and I believe this. The last 6 months specifically, for me at least, have been not only in terms of the market, but just the economic backdrop, as confusing as it's been from quite some time. What are the parallels, if any? Analog is a word we use from time to time. What you've seen over the last 6 to 9 months in comparison to what you've seen over your career, does anything sort of stick out? Like, I remember this happening here type of thing.
Yeah, well, I mean, a couple of trends. So, one, I talked about earlier, sort of the inverse relationship we're seeing where prices are going up, estimates are coming down. I think that's something we do see, on shorter phases. And again, obviously, while earnings are a key driver of market prices, there are other factors as well. And I'll turn that back to you guys as the market experts, whether it's interest rates, inflation, that sort of thing. But I do think over the longer term, if you look at 10-year, 20-year stretches, that's where, that correlation comes back, and earnings are the driver of prices over a longer period of time. And one other trend to keep an eye on, right now we're seeing expected 3 straight quarters of earnings declines. Over the last 15 years, it hasn't happened too often, but surprisingly, it has happened in recent years. We had it in 2020 with the pandemic, and it also happened in 2019, coming off a tough comparison in 2018 to tax reform and profits being much higher in 2018 due to tax reform. So there are some historical parallels there in terms of multiple quarters of earnings declines.
Yeah. And again, this has been a pretty weird few years here. We think about the pull forward, you think about, just some of the largest, earnings contributors to the S&P 500. They're massive U.S. multinationals, and they're also digital companies, and they benefited from just some of the disconnects that we had during the pandemic, and then obviously the reopening. And they're also very exposed to the dollar. So for instance, when the dollar was raging, the last few quarters, it did top out in the fall. I mean, that was obviously a headwind to those earnings. You would think that, again, right here, the dollar down, 10%, the US dollar index from the highs, it's still up a little bit. So this is going to be something that we did hear on some of these calls so far that the dollar remains a headwind, which, Guy and I were kind of scratching our heads as we're kind of thinking about some of those calls here. Listen, John Butters, we really appreciate it. We're going to kind of move over to energy. That was a great baton pass, if you will, to Matthew Hagerty here, because I think that last point that you made, that energy sector is projected to be the largest drag on earnings growth for the index in calendar year 2023, after being the largest contributor earnings growth in calendar 2022. Matthew, welcome here. You're speaking. Wait, the charts that you bring, and Guy, I know you're all geeked up. You love rig count. I mean, you get charts like that, and you get pretty excited here. Let's talk a little bit about some of the mechanics in the space in which you track very closely, because Guy, these are things that you talk about a lot. Do you want to quickly just kind of set the stage before we get to kind of Matthew's work and some of the charts here, how you've been thinking about the energy sector? And again, that contribution in 2022 did a lot of heavy lifting for the S&P 500.
Yeah, no question. I want to hear Matthew's thoughts, but I'll say, and this is going to sort of dovetail into ESG next, but, energy sector for a long time. I mean, there are a number of different headwinds, different administrations, obviously. ESG was a tremendous headwind for energy sector. And then when you saw that minus $39 print in front month crude oil, I think it was 2 Aprils or so ago, I think that was sort of the final nail in the coffin. And what I've sort of posited a number of times is all those different factors, Matthew, have forced these companies to basically become better companies, where they can just no longer rely upon the underlying commodity. They had to be more fiscally responsible. They had to get themselves up to date, up to speed in terms of ESG, and they had to get their balance sheets in order. And quite frankly, I think over the last 18 months to 2 years, I think many of these companies, Matthew, have done exactly that. I'm not looking to play stock market, but maybe speak to that phenomenon in the space.
Yeah, I think certainly. I mean, you're seeing, over this time frame from the boom years of 2016, 17, 18, over that period, obviously E&Ps were losing cash left and right. And so you started seeing this build in momentum that investors were really leaving the space. And so there wasn't really yet a catalyst, though, to focus on this capital discipline. But the pandemic really brought that on as a catalyst, because all of a sudden, producers were filing for bankruptcy and they couldn't get access to those capital markets. So it really forced a change for these producers to then focus on, giving cash back to their shareholders in terms of dividends and share buybacks and paying down debt. And so that creates, like you said, a much healthier company today. But also, where we look at ourselves maybe last summer when there was all this upheaval in the energy market, U.S. producers were no longer willing to be that marginal producer to really produce up to and balance out global markets. And so that certainly created some volatility in pricing when OPEC really had no other option. They were producing about as much as they possibly could.
It's interesting, Matthew. A couple of weeks ago, I know you know this, and I know the audience knows it as well, and we talked about it on Fast Money that night, but Chevron, 2 days before they reported, they announced a $75 billion stock buyback. Yep. That represented approximately 20% of their market cap. We were... I think we were sort of interested in the size of that, but obviously then the next day you saw some of the rhetoric out of the administration. They talked about it briefly last night as well. So there seems to be a bit of a political crosshairs on the back of these companies. Does that pose a headwind, do you think, or is that just a lot of much ado about nothing, to quote Shakespeare?
Yeah, well, I certainly think that, as you see these pressures from the regulatory agencies, it doesn't make it any easier in an industry that is already incredibly racked with regulatory headwinds. You're seeing a move towards reducing emissions across the energy space and really across the entirety of the financial sector. And so just it adds another straw onto that camel's back that maybe at some point it just becomes too much. But at least for the time being, you're rolling with you have to think also about the years of loss in 2017, 18, and 19. So at some point those have to even out of how you pay back your shareholders.
Yeah. So Matthew, when you think about those announcements, and also Exxon, made an announcement, not the size that Chevron did, You know, it was interesting that Chevron sold off like nearly 10% right after that. So hopefully they had that buyback in place and they had the opportunity to do that. But talk to us a little bit about, you know, John's, his work, just saying, you know, how much of a contributor energy earnings were last year and how they expect to be a drag in the back half of the year. And is that one of the reasons why we've seen these sort of buyback announcements to help kind of buoy earnings per share in the space?
Yeah, I certainly think that that's part of it. But another piece is, you know, the volatility that we saw in 2022. You know, you hate to say that any war or tragedy like what we've seen in Ukraine and with Russia invading is a positive for anybody. But if anyone did take advantage of that, it was some of the energy companies, and so they were able to fuel cash flow because of the increases that we saw in pricing over that time frame. But you know, as we get into 2023 now, you know, one thing that we've been calling for is lower pricing, especially on the natural gas side. You know, natural gas markets are one of the things that we love to talk about at BTU and at FactSet. So, you know, the incredible upheaval that we saw in 2022 literally fueled the massive production that we're seeing from natural gas currently. And that's fueling natural gas prices where we see them today of well below $3 an MMBTU. But when it comes to an earnings standpoint, you know, that's, as you mentioned before, and as John mentioned, I mean, it was a huge contributor to the S&P last year. And so just following that up becomes much more difficult when you're seeing cost inflation literally skyrocket and you know, seeing a whole lot more headwinds for the E&Ps and other actors.
Let's talk about nat gas, because it was, you know, 13, 14 months ago, we started talking about the potential for Russia, Ukraine. It subsequently happened. You saw a huge spike in nat gas. When I traded commodities for a living, we used to call natural gas the widowmaker for a myriad of different reasons. I mean, people have made and lost careers on the back of trading it, but the move higher in nat gas that we saw was epic, and then the subsequent move lower was equally epic. I think a large part due to the fact that Europe got really lucky. I mean, lucky is a probably strange choice of words, but in terms of weather specifically, you know, the mild winter certainly helped. But speak to sort of the backdrop now for nat gas and how it looks going into now in earnest 2023.
Yeah, I think one of the pieces that really drove pricing in 2022 is obviously the upheaval across Europe with Russia's invasion of Ukraine. But I think that was really a transitory dynamic, just given how the U.S. natural gas market very much still is a U.S. natural gas market. You know, there is some connectivity to international markets through LNG exports, but that's only a piece of the overall market here. And so when you have so much production that is coming out of areas like the Northeast and the Haynesville in Louisiana and East Texas, and then, you know, as well in oil-driven basins like the Permian, you know, those areas are fueling a lot of production growth, and we have nowhere else that we can really send it. You know, there isn't a whole lot of new export demand that is on the way here. And so how we see that interacting with pricing is that you see a lot more production coming online, but not nearly as much new demand coming on in 23 or 2024. And so what that fuels for us, and we've been calling for this for probably over a year now. One of our senior analysts, Connor McLean, you know, leads our nat gas analysis, and he's been calling for declines in natural gas pricing for some time now. Lo and behold, it happened a little bit faster than we probably initially modeled it, and that's strictly because of those weather dynamics that you highlighted. But what this means is for producers, you know, you've got a lot less cash flow coming in the door, and so they've got to tighten their belts a little bit and decide if they're going to focus on these dividends and share buybacks that they've been talking about, or do you find a different way to, you know, stabilize production?
Yeah. So when you think about stabilizing, you know, production here, and I think Guy, you know, started this conversation out that these companies have been forced to kind of operate better, right, Guy? And so therefore, it's just a different sort of environment here. I'm just curious, Matthew, you know, when you think about usually, and I think Guy, when he used the term widowmaker, it had to do with the fact that, you know, weather events were black swan events. I mean, they were just really hard to predict. And now all of a sudden, you know, Guy also mentioned that, you know, the situation with Ukraine and Russia was on the radar, but no one, everyone was hoping it didn't happen.
Yeah.
You know what I mean? And then maybe it wouldn't be as bad as expected. But now all of a sudden, geopolitical, issues have kind of been added to the kind of weather ones. And I'm just curious, like how you guys think about that and trying to model some of this stuff, because it really is obviously unknown. And there's other parts of the world that, we might have geopolitical dust ups. And after this, few years of COVID, all of a sudden, energy has become a huge concern as it relates to national security, supply chains, and the like. And I'm just curious, that's probably made your job a lot tougher.
Yeah, it certainly has. But, luckily we've got a great team of analysts with us that, help us sift through all the news and figure out, how to best interpret each of these geopolitical events. But you're certainly right. I mean, when you take one of the largest energy producers in the world with Russia and, cause an upheaval from that, that's the magnitude of that is incredibly hard to predict. And, luckily we were, kind of directionally right, but I don't think anyone saw just how far north it could have gone. And, I will just say, I know we're running a little bit out of time, but we're usually a little bit more of the bearish ones in the room anyways. So, the pricing that we're at today, I think we were pretty spot on with it.
I think you guys did a tremendous job in your analysis for sure, which is why I wanted to sort of your forecast for 23. It's interesting, and we're going to jump to Eli in a second, but we had Carter Braxton Worth on Market Call, and nat gas provides some amazing trading opportunities. So, the fundamentals that you just outlined probably are spot on, but the trading opportunities are going to be unique, I think, in 23. Matthew, thank you. Let's bring in Eli Reisman real quick, Senior Vice President, Senior Director of ESG Product Management. How are you, Eli?
Doing great. Happy to be here. Thanks for having me.
I tell you what, I think 2022, and you can speak to this, I'd like to hear your thoughts, I think was the year when everybody sort of figured out their ESG mandates and wrapping their head around it, and financial responsibility, the responsibilities that around ESG. Speak to that, because I think once that foundation has been laid, I think in earnest in 22, I think things get a little easier for companies moving forward.
Yeah, so 2022, we saw a huge movement towards sustainable finance regulation taking hold in a number of different places. I think we're up to 20 different countries and regions now that are either ratifying or considering ESG regulation, which is a huge shift. And it's a huge shift, as you said, in the positive towards standardization of a baseline of ESG information. Many of the regulations are aimed at providing standardized ESG metric disclosure from companies as well as investors. And it's certainly in the EU become the primary focus from our clients. We hear about the need to comply with SFDR all the time from our client base. However, when we're looking out to 2023, as all of these different countries and regions are considering slightly different regulations, it's important to note that if there's not a harmonization effort across these different countries, we're likely going to start seeing some pain points for both investors and corporates, mainly global investors, global corporates, who are going to be exposed to and having to disclose to a ton of different systems. So there's going to, as this continues to play out, there's likely going to be a lot more chatter about harmonization of all of these different regulations.
I know you focus on these things, and greenwashing, the amount of times it's been mentioned in your world, I think it's up. I saw the number 130% between December of 22 and December of 21, and it's a 450% increase from the prior year. So obviously this has become top of mind. Speak to this and what it means and the importance of all this data in this graph.
Yeah, absolutely. And I think it's worth tying this into the ESG regulations or the sustainable finance regulations that are coming out. A lot of them are aimed at trying to get rid of greenwashing in the marketplace. And so it's no surprise that we're seeing a significant uptick in the number of mentions of greenwashing across different FactSet sources. Here we're looking at news, research, earnings, transcripts, filings, and in these sources, we're seeing significant increases in the amount of focus on greenwashing. The interesting thing about greenwashing is it's not the easiest thing to quantify for investors. And so, our investors are coming to us, or our clients are coming to us and are trying to find ways to quantify and measure the exposure they have to greenwashing. And it really takes different types of data in order to get at the greenwashing that's happening. Because most of the ESG data sets out there are company self-disclosed or based on company self-disclosed information, there's a need for more timely and timely data, as well as data that balances the perspective from what companies are saying about themselves.
Well, that sets me up for my next point, because the ESG data market, the year-over-year increase, I think the annual growth rate is 28%, as you measured as well. So people are trying to get themselves up to speed in terms of the number of searches and the data that they're looking for. Why is that important? Speak to that, please.
I mean, this is a huge one. I think the number of ESG use cases in the marketplace is growing all the time. I think with the addition of regulation, you're seeing investors needing different types of ESG data for different use cases across the board. And with that increase in the annual increase rate of 28% in the data market, investors are having to buy more and more data sets, and oftentimes they can't get all the data they need from the same vendor. And this really causes a problem for our clients, where they're having to take 5, 6, 7 different ESG data sets from different vendors, and then having to bring all that data together in order to provide solid analysis. There was a great study by Harvard that looked at integration challenges for companies. And you can see that the top 2 integration challenges each have implications for bringing data together. The number one integration challenge is that there's a lack of consistency between ESG ratings providers, which oftentimes mandates that investors are buying multiple ESG data sets in order to cobble together a holistic analysis. The number 2 issue is that clients are having difficult times actually accessing information and data, which is oftentimes exacerbated when you're trying to connect multiple different data sets together. So what we're likely going to start seeing in the marketplace is clients focusing on vendor consolidation, as well as trying to find solutions where they can bring multiple ESG data sets together and have them sort of connected for them.
I think the institutional investors, believe it or not, I found this incredible, spending on average $500,000 for ESG data, which is pretty staggering if you think about it. So as that becomes more, I would imagine, centralized, whatever the word is, I would imagine that cost goes down. But then it goes into sustainable finance initiatives, which, again, a very difficult thing to sort of wrap your head around, but such an important component of ESGs. Can you speak to that?
Yeah, I mean, there's the increase in spend that's happening, and I think the 500K number is an average across institutional investors. When you're looking at large institutional investors, that's a very small budget for ESG. I think the way to think about this is that those ESG dollars have to spread across multiple different use cases. So thinking about being able to disclose to regulations, that's going to be a slightly different data set than trying to identify thematic exposures within a portfolio, or trying to align a portfolio to the sustainable development goals. And so there's just a number of different use cases that are continuing to pop up in the ESG space that clients are needing to react to, because their clients, the investors' clients are asking for them. And so there's more and more ESG data sets that are needed in order to meet those needs.
All right. Well, that was a great conversation. It's one that I didn't participate in much, because I am learning about it and just the importance of it. It used to just be, Guy, I felt like just a hot button topic, and it was really divisive on both sides. And I think a lot of the stuff around this topic have really worked themselves out because of some of the issues that we've talked about here as it relates to energy, and I think the differing views about energy. So listen, thank you very much, Eli. Let's bring all these guys back up here. I just want to say to our Market Call viewers, you're going to see all of them more with us on these really important topics. So we want to thank John, Matthew, and Eli, and you can find their work at their daily insights at insight.factset.com/subscribe. So go there, subscribe to it. You'll get all their work in their inbox. Guy and I do. And I just want to say this is that, Guy started out this call by saying, these guys have been great partners to us, FactSet. We don't only stare at FactSet machines all day long. Guy and I use a lot of the tools, a lot of the analytics, a lot of the insights for our own analysis analysis that we work into our market call in our On the Tape podcast, our OK Computer podcast. And then you'll hear us talk about FactSet on CNBC's Fast Money too, because we are quoting it. They're important inputs to us. So thank you guys for all the great work that you do. Thank you for the support of Guy and I and what we do over here at RiskReversal Media. Guy, I'll kick it over to you.
No, I know it's helped me personally become better at what I do now. A lot of people would say you could have only gotten better, but which is also true. But, when you read through the work and try to understand and you look at the screens and John's work, Eli's work, Matthew's work, and a number of other people that we'll highlight as well, it just helps make our jobs a little bit easier and helps us sort of discern, synthesize, and understand the information that they put out on a much more granular level. And they make it easy and accessible. So I want to thank you as well, fellas. Thank you for your participation.
Great. Thanks, guys. We'll see you again soon on Market Call. Thanks a lot, guys. Thanks so much for being here and watching this with us. Thanks.
All right. See you.